So it's a nice time we come in for a session of advanced financial reporting. So we are still under the International Accounting Standard 7, that is on how to prepare the statement of cash flows. So under this session, we are going to cover a question in the advanced financial reporting and analysis in the advanced level of CPA. So to illustrate more, or to illustrate about International Accounting Standard 7, I would like to do a question of November 2016 from the CPA perspective, that is Advanced Financial Reporting and Analysis. So this question says that the following are the group income statement and the group statement of financial position of Kichiko Group of companies for the financial year ended 31st October 2016. So you can see there you are given an income statement for the year 2016. So that the next thing which will be provided down here is all about the statement of financial position for the year ending 2016 October and 2015 October. Additional information: an item of plant with an original cost of 850 and with a net book value of 450 was sold for shillings 320 during the year ended 31st October 2016. Other investments were sold for 300 during the year ended 31st October 2016. So remember that the first additional information, they are saying that the plant with an original cost of 850 and with a net book value of 450 was sold for 320. So we need to check if there's a gain or loss on disposal on that plant which was sold. Additional information number 2, other investments were sold. Again, we need to check if there's a gain or a loss. Number 3, during the year ended 31st October 2016, Kichiko acquired 80% of the share capital of Sahani. The assets of Sahani were as follows as at the date of acquisition: property, plant and equipment, inventories, trade receivable, loan notes, trade payables, bank balance, tax, net assets. So the following information relates to property, plant and equipment assets: 31st October 2016, 31st October 2015. So you have the cost and accumulated depreciation, net book value. So this note 4, it's all about the breakdown they have done concerning the property, plant and equipment, which was provided there in the statement of financial position. So you can see under the statement of financial position, your PPs as 38 and 3050. 38 and 3050. And so they have shown that in order to get this net book value, they had deducted what? They had deducted accumulated depreciation. So the cost of property, plant and equipment of Sahani on the date of acquisition was 1,000, and the accumulated depreciation on the property, plant and equipment was 400 million. During the year ended 31st October 2016, there was a revaluation gain of 100 attributable to holding company's property, plant and equipment. The total purchase consideration of S Limited was 450, paid by issuing 100 million worth of ordinary shares at par. The balance was paid in cash. Depreciation and loss on sale of plant are included in the cost of sales. The required group statement of cash flow in conformity with I-7 statement of cash flow for the end of the 31st October 2016 using the direct method of presentation. So since we are doing a class, and I could drag you to learn more, I will do both. I will use both methods, the indirect method and direct. So let us start. So remember that maybe for the guys who have joined today, cash flow is just an analysis we are doing to check the sources and application of funds for an entity. So you will be given an income statement for the year Like now, you are given an income statement for the year 2016. And you would be given transactions for the statement of financial position as at the end of the year and at the start. Because now our financial year ends on 31st October 2016. It starts when? So there's a year which is ending on 31st October 2016. There's another one ending on 31st October 2015, which means that this one ending 31st October 2015 is the one which will open in the current year, because this current year of October 2016 starts on 1st November 2015. So obviously after 31st October 2015, we always move to 1st November 20. We move to the 1st November 2015. So which means that my transactions for the previous year, will be the opening for the current year. And already you are provided for the one at the end of the year. Then you are told the income statement is for the year. The income statement is for the year.
Excuse me, please.
Yes.
Sorry for the interruption. This the paper for which year, please?
These are paper for November 2016.
Okay, thanks.
Yeah, that is okay. Welcome. So after we have done analysis of the dates, we move now to the presentation, of which I've said I will use both methods. That is direct and indirect method, even if the examiner was in need of the direct one. So let's start with indirect, then we will do direct later, because the only part which will be different in the two methods is only the operating activities and how you present the operating activities. So we talk about Kichiko Group, consolidated cash flow, consolidated cash flow statement. So that is for the year. For the year ended 31st October 2016. So we have the operating activities. So under the operating activities, we always start from the profit before tax. So profit before tax. Then we say adjust for. So we adjust with the non-operating items, the one which were used at arriving at the profit before tax. Things like depreciation, impairment, loss on disposal, gain on disposal, finance cost, investment income, share of profit in associate or joint venture. So the one I've mentioned there. So, but now you come to understand them. I have just mentioned them. Once I write them down, you will be able to get them. So the profit before that tax is 3,200 from the income statement. 3,200. So let's adjust this our profit with the non-operating items, which it includes even the non-cash flow items. So which were used at arriving at the profit before tax. So we adjust now them again as that profit before tax. Which are these items? Depreciation. You just write them before even you check in your question if they are present. Impairment. Amortization. You just write them. This one you just write before even I go to my question to check are they present or not. So loss on disposal, and we have the gain on disposal. Loss on disposal and gain on disposal. My good students, when we provided with a depreciation in the question, you have the questions, guys? Hello, you have the question?
Yes.
So is there anybody who doesn't have the question? Is there anybody who is just following from my end? So which means that all of you have the question. But again, I've shared that question to your WhatsApp group. So if you have another gadget other than the one you are using, you can open so that you will be able to follow with ease. So we can continue. So I was under the point of checking now if there's depreciation, if there is a impairment, amortization, loss on disposal, and gain on disposal. So let's go to the question and check if there's depreciation. If there's no depreciation, you have to compute. Right now, the last question we did, the one for Maneno, the one for 2017, we were given depreciation direct. But now when you see they have done analysis of that PP, never think that they will give you again depreciation. Yes, there is some questions they can do that and give you the depreciation for the year. Like now the question of 2018, of which I will be able to do it if time allows in our next session, or I give you as an assignment. If you will be capable of doing it, there's no use I do it again. It's the question for 2018. I will specify which year. So for now, let's concentrate on this one. So checking on note 4, what you are given is accumulated depreciation. And remember, depreciation is based on the fixed assets. So you are given an accumulated depreciation. What are we supposed to do here now to get depreciation for the year? Obviously, we have to go and do our first working. We have to go and do the first working, that is concerning depreciation account. So when I prepare depreciation account, my good students, I always do 3 accounts at the same time, including the depreciation. So I always do another account called disposal account, and I always do PP analysis. But PP I will consider to do it direct. PP analysis, I will not do it as a T account. This one I will do it direct, the PP analysis. So remember that for the disposal account, it's very easy because this one here is cost of the asset which was disposed. Accumulated depreciation you raise of the asset which was disposed. Then you raise again the proceeds. So checking on additional information number 1, you are given an information of that kind of an asset which was disposed. So you were told that in the additional information number 1, an item of plant with an original cost of 850, with a net book value of 450 was sold for 320. Proceeds is 320. What about depreciation? What is the depreciation figure there? Which is the depreciation figure here? How do you get your accumulated depreciation? Or a simple question, net book value is equals to what?
Cost minus accumulated depreciation.
And you are given cost. And you are given net book value. So you can get your accumulated depreciation, the one which was subtracted from 850 to get 450. It's 850 minus 400. That is 400. That is 400. So with this account, we are done with it because now I can see there's a loss here. If it was the balancing figure was on the debit side, that is when you say it's a gain. So we have a loss of 720 minus 850. Let me get a calculator. Give me the answer there. What is the answer?
130.
So that is 130. So that my depreciation, the balance brought down. Balance carried down. So I'm talking about the accumulated depreciation figure you are given there. The balance brought down for the accumulated depreciation is checking on additional information number what? Number 4. At the start, the depreciation is 29. At the end is 34. When I mean at the start, I mean the one for 2015. At the end, 2016. So 29, 34. So 29 and 34. Then we need to check anything else to affect depreciation. Remember that this one is the depreciation on a disposed asset. So which means that once it's credited here, I have to debit here. That is 400. And then after that, remember there was an asset which is a subsidiary, which was acquired. When it was acquired, there was an asset on that subsidiary. There was net assets, including PPE, that is property, plant, and equipment. This one, the 600. Property, plant, and equipment, 600. So remember that this is an extract. This is an extract of a statement of financial position of Sahani, which was acquired. So this is just an extract of the statement of financial position. So which means that this 600 is at net book value. It's at net book value. Checking on the additional information number 4, the statement which is down here, you are told that the cost of the property, plant, and equipment of Sahani, cost of the property, plant, and equipment of Sahani on the date of acquisition was 1,000. So the cost was 1,000 and BV is 600. So which means that which amount was deducted to get 600 from 1,000? It's 400. It's 400. That is why when they went ahead to say, and the accumulated depreciation on the property, plant, and equipment was 400. So remember that Sahani was done once. Sahani was acquired. So which means that we have to debit, not debit, but credit. We have to credit Sahani's accumulated depreciation here. It will increase the depreciation account so that now the balancing figure would be my depreciation for the year. So this is 3,800. So on the other side is 2,900 plus 400. 3,800 minus 100, that is 500. So my depreciation here would be the one I was looking for, would be 500. So that the total is 3,800. Then I will come here and talk about PP analysis. I said I will do it direct. So the balance brought down is what? The balance brought down of the property, plant, and equipment. The balance brought down. I will check from my statement of financial position. I want to use the net book value approach. So I will go with the figure of 3050 at the start. When I say at the start, I mean balance brought down is at 2015. Balance carried down is 2016. So I start with the balance brought down. I make adjustments during the year before I compare with the balance at the end. So after starting with 3050, I have to check the additional information. What can affect property, plant, and equipment? You know that what is a property, plant, and equipment is all about fixed long-term assets which have been aggregated. So we have note one. Note one, remember there was plant which was sold. Plant which was sold, so it was disposed. So we need to record that disposal. We need to raise the disposal. And since I have said I'm using the NBV approach, so I have to minus the net book value of that asset, which is the plant, as note one. So which is 450. 450 was the NBV of that plant which was disposed. Then after that, we need to move to additional information number 2 to check if that one affects your property, plant, and equipment, but it doesn't, because it's an investment. An investment is an intangible asset. According to International Accounting Standard 16, we don't include intangible assets under property, plant, and equipment. You can read more about property, plant, and equipment under the International Accounting Standards 16. Number 3, during the year ended at 1st October 2016, Kichiko acquired 80% of the share capital of Sahani. The assets of Sahani were as follows as at the date of acquisition. Remember that Sahani was acquired. Sahani is a subsidiary which was acquired. When it was acquired, it came with net assets, including property, plant, and equipment, which was stated at 600. The first net asset I can see there. So the Sahanis on Sahani, so the PPE. So that is 600. Remember, this one was acquired. I would add the 600. I would add the 600. Moving to note 4. Note 4 is just an analysis which was done based on the property, plant, and equipment. The statement which is down there, they say that the cost of property, plant, and equipment of Sahani on the date of acquisition was 1,000. But I needed to record at net book value, the one I recorded, which is 600. That is after taking 1,000 minus 400. But already they provided us with the net assets of Sahani, whereby PPE was stated at 600. So there's no use of me going ahead again to do the working, since we have the 600 direct, of which we know it was 1,000 minus 400. So there are sentences there in that statement of note 4. They say that during the year ended at 1st October 2016, there was a revaluation gain of shillings 100 million attributable to the holding company's property, plant, and equipment. Revaluation gain of what? PPE. So the revaluation obviously we have to add revaluation of PPE. So the 100. So the 100 will have to be added there because it will increase the value of the asset. To be more specific, the fixed asset, which is classified under the property, plant, and equipment. Note 5, they say that the total purchase consideration of S. S is Sahani. It's all about now the examiner is trying to give you a small challenge so that you think of S being a different entity. But S is just Sahani, the subsidiary which was acquired. So they have said that the total purchase consideration of Sahani was 450, paid by issuing 100 million worth of ordinary shares. So that one can never affect our property, plant, and equipment. Even note 6, it's concerning depreciation and loss on disposal, whereby they are saying that those depreciation and loss on sale of a plant are included in the cost of sales. So far, we have made the adjustments which are supposed to affect our property, plant, and equipment. So 3050 minus 450 plus 600 plus 100. So, but there's one thing I have not deducted, which is that one thing, depreciation. There's this depreciation which we computed here. So depreciation, we have to deduct the depreciation for the year, the one we did from the first tier account there, from our first tier account. So if I take my 3,300 minus 500, I would be able to get my 2,800. So I will compare with the balance carried down. I will do a comparative analysis. So the balance carried down of the property, plant, and equipment was, it was
3,800.
It was 3,800. You can check from note 4 or from the non-current assets under PPE. You can see in 2016 it's 38. It's the same one which is under the non-current assets there. So 38. So when it has increased from 28 to 38, we say there's another asset which was acquired. If it was a reduction, we could have concluded that there's a disposal. So in this scenario, there is an asset which was acquired at 1,000. So that 1,000 will never affect our operating activities, but it will affect the investing activities, of which we will call it cash paid to acquire an asset. For now, I was doing just our first working to determine depreciation, of which depreciation was 500. Then we got even loss on disposal for my second tier account. The loss on disposal was 130. That one was 130. So what I need to check now is two things. Is there impairment or amortization? So for you to conclude that there is impairment, in the non-current assets, you must be provided with goodwill. You must be given goodwill. Is there goodwill under the non-current assets? Is there goodwill under the non-current assets? So if there is no goodwill, there is no impairment. They said intangible assets including goodwill, but they never mentioned specifically that the goodwill is this one. They said intangible assets including goodwill. There's no another thing that just they said intangible assets including goodwill. So which means that there's no impairment. Even amortization is not there because there's no another specific intangible assets like patents, trademarks, and others. So when you are given intangible assets, what can you compute? What are you required to do? Other than yes, doing an impairment, of which we have said that there's no impairment. What can you do? So when you are given intangible assets, what you are supposed to check is either if there is acquisition of an intangible asset or disposal of intangible assets. But you can only do this by doing an analysis by starting with the goodwill of the subsidiary which was acquired. You have to do first the goodwill of Sani. The goodwill of Sani, and you know that the goodwill can either be computed using the full method or partial method. And this one, goodwill would be computed as at the time of acquisition. Remember that Sani was acquired. Remember that Sani was acquired on which period? It was acquired during the year 31st October 2016. You can read that from my note 3, the one displayed on your screen. So Kichiko Limited acquired 80% of the share capital of Sani. So for now, I don't want to read a lot of things. So what I wanted to look for, which method am I supposed to use in the computation of the goodwill of Sani? So I can see already it's partial method. Why? Because there's nowhere I can be able to, there's nowhere I've been provided with the fair value of the non-controlling interest. For you to use the full method, the non-controlling interest must be measured at its fair value, of which there was no point which was mentioning that. So how do we compute goodwill? We take the purchase consideration minus the share of net assets. No, purchase consideration in the acquisition of Sani is given in note 5, whereby they said it was 450, paid by issuing 100 worth of ordinary shares. So the total is 450, even if part of it was paid through shares. So what we do, we say purchase consideration minus the share of net assets. So my purchase consideration is, and that is 450. We raise net assets, so the share of net assets. So the net assets are the one which were acquired when Sani was acquired. So Sani was acquired up to 80%. Sani was acquired up to 80%. So which means that its net asset, which it came with, is total 500. This total 500. So you record that 500 there. So the 500 times 80%, that is 400. 80% of 500, that is 400. You minus, you get your 50 is the goodwill. But now, since under the non-current assets, we were never given goodwill, but intangible assets, we were given intangible assets. I said once we do analysis of these intangible assets, either we have to get acquisition of intangible or disposal. But remember to incorporate, when doing your analysis, you incorporate this goodwill of Sahani, which was acquired during the year. So the balance brought down for the intangible assets. The balance brought down for the intangible assets is So the intangible assets, you are told it's 2,000. 2,000. At the end, I can see there 2016, it's 25. But before I compare with that, I need to add the goodwill of Salani. The goodwill of Salani, which is 50. So I get 20, 50. So the balance, I would skip one line and say balance carried down. So the balance carried down is 25. So you can see it has increased from 2050. There's an increase from 2050 to 2500. So which means that there's an acquisition of intangible assets at 450. This one again will affect investing activities. That one again will affect investing activities. Let's check if there's gain on disposal, either in the additional information or in the income statement. So before I go back to the income statement, is there any gain on disposal under additional information? Under the additional information, there was, there is that gain. Where is that gain? Remember that in additional information number 2, in the additional information number 2, you were told that after investment was sold for 300 million during the year ended at 1st October 2016. Other investment was sold for 300 million. So going back to the non-current assets, you can see other investment is this one here. They were sold at 300. That is why you can see there's a dash. So which means that they were sold at 300. So initially it was at 250. So they were sold at 300, which is a gain of 50. They were sold at a gain of 50. And since we are adjusting our profit before tax, gain we have to deduct. Gain we have to deduct. After we are done with that 5 items, we have checked if they are present or not, of which some of them which were present we have recorded. We have to go back to the income statement. We have to go back to the income statement. We check the other items to adjust against the profit before tax. So the other items to adjust under this income statement, we go and check under profit before tax. I will put my cursor here and I will move backwards. Other than revenue, which is a correct operating item, cost of sales, distribution, and admin. Other than the 4, the other items which are there, which were used at arriving at the profit before tax, they are non-operating, and we need to adjust them against the profit before tax. So starting with investment income, share of associate companies' profit, and finance cost. So like now the other incomes, not other incomes, but investment income of 250. So investment income of 250, it needs to be done what? Subtracted. It was added. It was added. So we subtract. Share of associate company profit. Share of associate company profit. Share of associate company profit. The 200. 200, again, you need to subtract. Then finally, we have the finance cost. We have the finance cost. The finance cost is at 750. It was subtracted. We need to add. It was subtracted. We need to add. So I have recorded those 3. Investment income. I have subtracted the share of associate company profit, then the finance cost. So up to that point, what I'm getting is called cash flow before working capital changes. Cash flow before working capital. I will write in short, WC. So for your case, you can write in full. So working capital changes. You know that we always use this for changes in some scenarios. So cash flow before working capital changes. Cash flow before working capital changes. So 3,200 plus 500 plus 130 minus 50 minus 250 minus 200 plus 750 plus 750. So what are you getting? What are you getting, students? What are you getting, guys? So 500. So you are getting 4080. So that is fine. So you are getting 4080. There is someone who is saying that we are getting 4080. So that is 4080. So cash flow before working capital changes. Now the next part we move to is all about changes in working capital. So I can be allowed to clear the bond, part of it. But if there is anything you would like to see, I can display for you before I clear the bond. So changes in working capital, working capital. So the changes in working capital, we need to check what? We need to check increase or decrease in current assets and current liabilities. Increase or decrease in current assets or current liabilities. Under the current assets, we have to check inventory and receivable. Under the current liabilities, we have to check the payables. So inventory 1020. Add the one which was on Sahani, even under this, before we do a comparison with the balance carried out. So the inventory under Sahani was, never forget to incorporate the figures of disposed or acquired subsidiary in any cash flow equation we are doing at your level, because that is the only thing which makes it to be advanced. The other things are just the normal things, from the financial reporting and analysis at the intermediate level. So the inventory is 400 and receivable is 300. 400, 300. So here I want to do the Matago. So this is 400, and this is 300. So is there an increase or a decrease? So this is 14, 20, at the end is 15. There's an increase. So I would say increasing inventory. Increase in inventory. So that is 1020 plus what? 1020 plus 400. And then is 1500. Then receivable, increase again. There's an increase in the receivable. So that 150 plus what? Plus 300. Minus 39, minus 39. So 1420 minus 1500. So there's an increase from 1420 to 1500 of 80. So when assets increases, there's cash outflow. When your assets increases, it means that there's money you have paid to buy some stock that is under inventory. So that 150 plus 300, that is even 3450. 3450, then it increased to 3900. So again, there's an increase of your debtors balances by 450. You deduct again. So the people who owes you money, that are increasing. So which means that you are giving them more loan. So there's money out. There's more money out. And so payables. Under the payables, we have 1990 and 2270. But never forget to incorporate the payables of Sahani. Sahani was at 400. 1990 plus 400. So that is 2390. So which means that at the end is 2270. There's a decrease. There's a decrease in payables. Decrease in payables. So you take 1990 plus 400. Then at the end is 2270. So 1990 plus 400, that is 2390. Then at the end is 2270. So there's a decrease by 120, decrease in liabilities. So decrease in liabilities, what do you do with them? You deduct.
Cash outflow.
Yes, cash outflow, you deduct. You have paid liabilities. So up to that point, we have cash generated from operations. Cash generated from operations. Cash generated from operations. So the cash generated from operations. So 4080 minus 80 minus 450. So that is 3430. So less tax paid. So once we less the tax here, that is when now I would say that I'm done with operating activities. So I would say cash flow from operating activities. So then once I will be done with that, I will move to investing, not financing, investing activities. So let's do tax. Let's do tax. Tax is under which standard? International Accounting Standards. You've forgotten. I think this topic I taught a long time ago when we started the sessions. Tax is under which standard? International Accounting Standards 12, whereby you are supposed to know how to compute for the deferred tax and the current tax. So which means that when I will be doing my working for tax, I would have to combine current tax and deferred tax. I would have to combine them if they are present, both of them. But only if we have current, I have to deal with that current only. But if both are present, of which you know that deferred tax is an non-current liability, of which I cannot see it under the non-current liability, which means that there was no deferred tax. The only item given there, the only tax provided there is the current tax at the start. Balance brought down is 1,100, 1,100, 1,100. Income tax for the year from the income statement. Income tax from P&L. From the income statement is
1,400.
And so that is 1,400. The next thing we have to consider the tax of Sahani. Sahani was acquired. So since this is our session which is recorded, at least maintain your background a bit when you answer the question anyway, or you can chat so that everything will be okay. The main thing is understanding, and if you are not getting what I'm doing, please, you are allowed to ask. So now, note 3, there is that Sahani, which was acquired, and its tax was 50. Its tax was 50. So up to that point, we have 2550. But the tax, that is the tax they are supposed to pay. So the balance carried down is of tax. So the balance carried down of tax, that is the current tax. The current tax, we have that figure of we have the current tax at 1,200, 1,200. So we have 2550. Then by the end, you are supposed to pay, instead of 2550, you are supposed to pay 1,200. So which means that there is a tax paid of 1,350. You already paid 1350. That is what I will deduct here from 3430. 3430 minus answer, that is 2018. This is my A. Then investing, I will start with cash received on disposal of assets. I will talk about cash paid to acquire an asset. I will talk about investment income. I will talk about dividend received, data from an associate or joint venture. Then I will check that subsidiary which was acquired, what was paid. So the cash paid to acquire the subsidiary, net of cash acquired. That's all for investing. That's all for investing. So cash received on disposal. So cash received on disposal, that was not one, it was 320. Additional information number 1. Another one, it was additional information number 2. Cash received on disposal of investment. I think you have the question. Cash received on disposal of investment, to be specific. There was that 300. That is another amount which was received. Now we go to the cash paid. Cash paid to acquire an asset. We did the PP analysis, property, plant and equipment analysis. There was that 1,000 we got in our working number 1. Cash paid to acquire assets. There was this we did here. This one, there are 1,000 which we got there. There are 1,000, so that is cash paid. Then there was another working we did for intangible assets. For intangible assets, we said instead of checking for impairment, since we have not been provided goodwill to be specific, what you go ahead to determine when you are given intangible is either acquisition or disposal. So we did that. We did that here. And we got an acquisition of 450. 450. So cash paid to acquire intangible assets. Cash paid to acquire intangible assets. So it was 450. We deduct, guys. We deduct because it's money out. The one I'm adding, it means that there's cash in. Then after that, is there anything remaining? Is there anything remaining? Yes. What is remaining? What is remaining? I said we have to consider if there's investment income. But if there was investment income, it is also adjusted under the operating, under the adjusted items against the profit before tax. So this one, the 250, you can see it is subtracted. So what I do on the other side here, investment income will be added. Investment income of 250. Then after that, we need to check now dividend received. Dividend received from who? Dividend received from. So it would be dictated by what investment we have in the non-current assets. Is it the investment in associate or investment in joint venture? So checking under the non-current assets, my good people, you can see that under the investment, you are told that there's investment in associate company. Investment in associate company. So which means that the parent, which was called Kichiko, other than investing in a subsidiary, other than acquiring a subsidiary, he acquired again, or he made an investment in associate as per the information given in the non-current assets. So we have the investment in associate. Investment in associate. So that information will aid me in the determination of dividend received. I will start with the balance drawdown of 500. I will add the income this Kichiko received from that associate, and that one is recorded under the income statement. You can see under other incomes, we have the share of associate companies' profit of the 200. We have 200 there. So that 200 is the income which the parent called Kichiko received from the associate, which initially had made an investment of 500. So 500 plus 200, that is 700. But checking on the investment in associate at the end is 650. Why it is reducing from 700 to 650? Kichiko received the dividends. So balance brought down 500. So share of associates, company profit as income, share of associate company profit, there was that 200. So initially he had made an investment of 500. He received an income of 200. The total is 700. But the balance carried out is 650. Why? There's a reduction of 50 because now the parent received dividends. The associate paid, but now the parent received. So that's why I would say dividend received from associate. Dividend received from associate. The one for 50. The one I'm recording there 50. Then finally, Sahani was acquired. Remember that. What did the Kichiko pay? What did the Kichiko pay? So I will say cash paid to acquire subsidiary. Cash paid to acquire subsidiary. Cash paid to acquire subsidiary. Net of cash acquired. Net of cash acquired. Net of cash acquired. So which was the cash paid to acquire the subsidiary? Remember that when Kichiko acquired this subsidiary called Sahani, in terms of cash, how much did he pay? Go to the additional information number 5. The total purchase consideration of S was 450, paid by issuing 100 million worth of ordinary shares at par. The balance was paid in cash. So the balance being 350. So 450 was in terms of the total purchase consideration, but we only need cash, cash paid. 100 of it, which was part of the 450, was in terms of shares. So we are remaining with a cash of 350. But again, we need to check when this company called Sahani was acquired, did it come with any assets, specific asset being cash? Did it come with any cash as part of net assets? That is why we always say that cash paid to acquire subsidiary, net of cash acquired. That 100, is it cash or an liability? Is it cash or a liability?
A liability.
A liability. It came with a liability of 100, which is not cash. So which means that one will again reduce our, or it will increase. Reduce or increase? It will increase this. Because if it was a cash, that is when I could have deducted so that our purchase consideration goes down. But now again, it has came with another liability of 100, which is a bank balance. So if it was a positive, that is when I could have deducted so that our purchase consideration is reduced, because now after we purchased the Sahani, it came with part of cash as its net assets. But instead of coming with cash as its part of net assets, it came with an overdraft, which is a bank balance, which is a negative. So this one will remain just to be 450. So up to that point, we are done. We are done with investing. So we have to talk about cash flow from investing activities. Cash flow from investing activities. The cash flow from investing activities. So do the math, the summation, that is. Do the summation, guys. Do the summation. At least I can have a break of taking even water. So under the investing, we can see there's a cash outflow of 980. So this is my B. So the 980. So let us do the last part, that is financing activities. So financing activities, remember that for financing, we will be checking things like if there was issue of shares, if there was some borrowings which was done to finance the organization. It can be from issue of shares, borrowings which are done. So in short, for exam purpose, what you are supposed to use is all about the items from the part of equity going downwards, the one you have not used. So this one. So the only thing I have, the only transactions here I have not used, or the one I have used is payable. I will not use it. Current tax already used. So the others will be used here from equity going downwards. Then bank overdraft, you know that is a cash and cash equivalent. It cannot affect financing, but generally the cash flow statement. So let's start from ordinary share capital. We combine it with share premium. We do analysis on that, either to check if there is a issue of shares or a redemption of shares. Remember that when you are doing analysis of the capital account, you either check if there was an issue of shares or redemption of shares. So I will combine my ordinary share capital and share premium. So the balance brought down being the balance brought down being what? So that is 1,500 plus 1,500 plus 1,500. That is 3,000. The balance brought down. So this one and this one. Then what can affect my capital? There was shares which were issued as part of consideration. That is according to note 5. This consideration of 450 was made up of 100 worth of ordinary shares. So which means that this one will increase our capital account. Shares which were issued as part of the consideration. Issue for issue of shares, issue of shares as part of consideration. So its value was so the value was 100. So up to that point, if there was again bonus issue, shares issued as a through bonus, that is, or through right issue, you record, but there was none. So this is that one. Then balance, you skip one line, you say balance carried down. So the balance carried down here is what? The balance carried down for the ordinary share capital and share premium members. The figures there is, we have the 2,000 and we have the 2,000 and we have the 16. So that is 36. 2,000 plus 16. That is 3,600. So which means that there was a cash. This is in terms of shillings. There was a cash which was realized of 500. A cash which was realized of 500 from that 100 to 3,600. So this one was automatically due to issue shares. If it was a decrease, I could have said that they paid money in order to redeem shares. If it was 31, then it reduced to, let's say, even 28. That reduction, I could have said that is amount paid in order for them to redeem shares. But now, since it has increased, this is amount they realized. when they issued shares. So I will come here and say cash received. I will come to my statement and say cash received on issue of shares, on issue of shares. So we have the 500. We have the 500. If it was a reduction, I think you know what I've said. Then the next thing is revaluation. Revaluation here cannot be used because checking on even the additional information, checking even on the additional information number 4, the information which was given in the last sentence of that paragraph, they say that there was a revaluation gain of 100 attributable to the holding company, property, plants, and equipment. So there was a revaluation of 100. Checking in my balance brought down of revaluation, my balance brought down is 910. If I adjust this by adding the 100, which is under the additional information, what you can check there we are getting is what? The 1010. We are getting this 1010. So there's no impact there. There's no impact there. So after that, we move to retained profit. Retained profit will assist me to get dividends paid by the parent. Dividends paid by the parent. So dividends paid by the parent. So that is what I would be looking for when doing the retained profit. So balance brought down of the retained profit. Balance brought down for the retained profit is, the balance brought down is 1,200. That is 1,200. I would have to add the profit attributable to the parent during the year. So after getting the profit for the year here, you can see, guys, in the income statement, after they got 1,800, there was profit of 1,650, which was attributable to the holding company, which is the parent. And then NCI was getting 150. So what you need to add here is the 1,650. So the profit to parent from P&L, the 1,650. So at that point we have 2,850. So you skip one line and see balance carried down. So the balance carried down there is the balance carried down for the retained profit. It will be a small amount than 2,850. It has to be a small amount. So 1,740. And the end, 2016, 1,740. 1,740. So this is 1,740. So the difference is the dividends paid. 2,850 minus 1,740. That is 1,110. That is the dividend paid by the parent. So dividends paid by the parent. So 1,110. We subtract. Then after that, the next thing you can see is NCI. Because share premium, we are done with it. Then the other figures there, those are totals. The next thing you can see there is the NCI. NCI, the non-controlling interest. The NCI. So that NCI figures, they will be used in the determination of the dividends paid. In the determination of the dividends paid to the NCI. So NCI, non-controlling interest. So the balance brought down is the balance brought down. NCI balance brought down. So the balance brought down of the NCI 300. That is 300. Then after that, we add that profit to NCI, the one from P&L. It was profit attributable to NCI, the last item in the income statement. The second last, that is 150. Profit attributable to the non-controlling.
150.
150. And another thing you come here and check is the NCI on the net assets of Sahani. You know who is Sahani? On the net assets of acquired subsidiary. So that is 20% of the 500. 800. I'm talking about the additional information whereby Sahani was acquired. Under those net assets, those are attributable. There is a percentage attributable to the minority shareholders. It was an 80% subsidiary. Out of this 500, there is 20%, which is going to the minority shareholders. Then finally, we have to add NCI goodwill on acquired subsidiary. If it's disposed, you rest. If it was a disposed, if Sahani was disposed, this one I could have deducted, even this one. But now it was acquired. That is why I'm adding NCI goodwill on acquired subsidiary. You will only have the NCI goodwill on the acquired subsidiary if full method is used. But we use the partial, you remember? Eh? You remember that. So there's nothing like this. So 300 plus 300 plus 150 plus 100, that is 550. Balance carry down of the NCI. Balance carry down of the NCI is
500.
That is 500. That is 500. So which means that there is a dividend paid of 50. The reduction. So dividend paid to the NCI. Then after that, the next thing is all about the loan. You have to check if that was acquired or disposed. Not disposed. Acquired, another loan which was acquired, or they made a repayment of loan. So if there's a loan which was acquired or they made a repayment. So at the start is 500, add the one for Sahani. Sahani is a subsidiary which was acquired. The loan which is there is 250. So 500 plus 250, that is 750. Remember that we are adding there to 50. So we are getting 750 anyway. But at the end is 1700. So which means that there is another loan which was acquired. Acquisition of loan, because at the end it's more than at the start. So it's 500 plus 250, 750. But at the end it's 17. So 1700 minus 750. That is a 950. Then after doing that, we check anything else which is remaining. Payable, we are done with it. Overdraft is a cash and cash equivalent. Payable, we are done with it. Bank overdraft is a cash and cash equivalent. Current tax, we are done with it. So the only thing I will record as interest paid, because we don't have any accrued interest, is my finance cost. Interest paid, you will just pick direct the finance cost and you record it as your interest paid, the one you are supposed to pay. Not the one you are supposed to pay, but the one you have paid, interest paid. interest paid. Interest paid, because we don't have any accrued interest to do some workings with. So my finance cost is 750 from this income statement of ours. From this income statement, so from this income statement, we have 750. Now we have cash flow from financing activities. So the cash flow from financing activities, that is 500 minus 1110 minus 50 plus 950 minus 750. Are you getting 460? So this is C. So net cash flow will be A plus B plus C. You know my A is and my B is, so my A is from operating, the results of operating. So it was 2080. And this one is 980. So 2080, 980 minus 460. So I'm getting 640. Add cash and cash equivalent. Balance brought down. So that you get cash and cash equivalent, balance carried down. So cash and cash equivalent, working. So we have 2016, we have 2015. You know, the cash and cash equivalent items, short-term investment, e.g. financial asset at fair value. We have cash in hand, cash at bank, and the bank overdraft. So checking on the current assets, checking on my current assets, I can see we have short-term investments. You record the way they are. So that is short-term investment is 500 and dash. Cash balance is the second one. Cash balance, that is 20 and 10. Then checking on current liabilities, we have an overdraft. We have a bank overdraft. That one you deduct of 850 and 980. $850 and 980. So if you do your summation, this one would be 970, which is a negative. 520 minus 850 is 330. So 300 is the one we raise here. 300,000, 970 is the brought down. Because now this is a brought down at 2015. then you are supposed to get 330 at the end. So if you say minus 970 plus the 640, which is the net cash flow. So you can see we are getting the 330, which is this one here. And that is how you do indirect method for this question. So now when I would be moving to the direct method, the only part which would change is the operating activities. Investing and financing will remain to be the same for both methods. So after we are done with the indirect method, we would like to go and do the direct method using the same method, same question that is. So this is a Kichiko group consolidated cash flow statement. Remember that I'm now using the direct one for the year. For the year ended 31st October 2016. But the only part which I will do is operating. So I will not do a lot of information. Never lose hope. Never feel that we are going to do a lot of work. I'm doing just a few workings here, which is concerning operating activities only. So I will start with cash received from customers. So raise cash paid to suppliers. Then you raise cash paid to employees. So to that point, you get cash generated from operations. Then you raise tax paid. After deducting the tax paid, you get the cash flow from operating activities. That's all. That's the format. So to get the cash received from customers, I do my first working concerning trade payables, trade receivable account. Remember your customers, sometimes when you sell to them on credit, they are your debtors. You are the creditor to them. You are the supplier. So balance brought down. This is an asset account. Balance carried down. So balance brought down, it means that the receivables as of 2015, the receivables as of 2015, that is at 150, and this is 39. At 150, 39 at the end. What can affect your debtors? What can increase the debtors balances? What can I debit? Which means that what I debit increases the debtors balances.
Sales. Kama ni revenue.
Yes, sales or revenue. Sales or revenue. You assume that it was on credit. Or would you, on this question, you have been told they are very specific. They are very specific that the revenue from credit sales is on 25, 530. So this is all about credit sales. Even if they say just sales and they are silent, you assume they were on credit. What can reduce is part that's written off. Discount around. If you allow a discount around. Remember, Sahani was acquired, so it's debt as well. So you debit. Debtors balances for Sahani, which it came with. And remember, it was acquired, so that's why I'm debiting. It increases that account. So the trade receivables is 300. Trade receivables, that is 300. So cash received is the balancing figure now. That 150 plus 25, 530 plus 300. 28, 980 minus 10, 900. That is 25, 080. So that here we have 28, 980. So this is 25, 080. So there's a question I'm seeing there on the chart. I will answer you once I'm done, because I have just seen that question now. So the next thing is all about cash paid to suppliers. So for the suppliers, the first working I have to do, this is my working two. Under this working two, my first working is to determine credit purchases. The one we purchased on credit from the suppliers. So credit purchases, we know that cost of sales is equals to what? Opening stock plus purchases minus closing stock. Okay? So we need purchases. So it would be, let's say purchases, it remains on that side. It would be cost of sales minus opening stock plus closing stock. Okay? So cost of sales was the cost of sales was 18,140. For which under cost of sales you will find that the depreciation and loss on disposal is included there. You know that one from IS1 published accounts. When we classify expenses, they are classified either under cost of sales, under administrative cost, under selling and distribution, or finance cost. You know which are expenses are classified under each functional head. So here they specified. So what you need to know, depreciation and loss on sale of plants were under the cost of sales. So you need to deduct them. So which means that we did this working area. Depreciation was 500. Remember, we did a depreciation account when I was using the indirect method. When I did my indirect method, I did these accounts. I got 500 for depreciation. Then I did disposal account. I got 130. So those are the one you deduct here. Then opening stock is just the inventory for 2015. But remember to deduct the one for Sahani from the opening inventory. So 2015, the inventory is 1020. So under 1020, add, not subtract. Remember, Sahani was acquired. So sorry for saying that we are supposed to subtract. It's adding. Eh? So remember that Sahani was acquired, so we add. So the inventory of Sahani was 400. Eh? So 1020 plus 400. Then closing stock is all about the stock at the end. Eh? Stock at the end of the year, that is 2016. The inventory as at 2016. Inventory as at 2016, 1500, 1500. The 1500. So 18140 minus 500 minus 130 minus 1020 plus 400 plus 1500. So who is getting this one? I'm getting 17,590. That is my credit purchases. Eh? And after that, you prepare trade payables account. Eh? So balance brought down. And we have the balance carried down. So the payables, balance brought down, that is 1990, 2270. Credit purchases will increase this account of ours. So we have computed 17,590. It increases what you are supposed to pay to your suppliers. Eh? Because you have purchased on credit. Other than the balance brought down of 1990, there's purchase which has been done on credit. And there's that one, Sahani came with. Sahani came with creditors balances off. So its trade payable was at what value? It was 400. Eh? It was at 400. That is according to note 3. So that if there was a discount received, there was none. So cash paid to suppliers, 1990 plus 17,590 plus 400, 19,980 minus 2270. That is 17,710. That is 19,980. That is 17,710. Finally, cash paid to supply. That is cash paid to employees. Last but not least, so for cash paid to employees, You check your administrative expense because most of those expenses will be under administrative or distribution. So your admin and the distribution is at what values from the income statement. So administrative expense and the distribution cost. So distribution cost is 1250. Then admin is 2640. Add the two. So the only thing I have to raise here and add, I have to raise some of the non-cash flow. Non-cash outflow items which have not been adjusted when using the direct method. The only items which have been adjusted was impairment. No, it was depreciation and loss on disposal. Those are the ones which were deducted under cost of sales. So other non-cash flow items, like if there was impairment, I will have deducted here. Then now I have to add the gain, because again, that is another item which has not been adjusted when I was using this direct method. Gain on sale of investments under note 2. Remember that there was an investment which was sold at 300, of which in 2015, under the non-current assets, under other investments, it was at 250, which means that by the end it was sold at 300, and there was a gain of 50. This one we have to add back because it was understating our expenses. It was understating our expenses. So that 890 plus 50. So that is 3940. So this one, I think this was the only difficult part. So that if you deduct that way, 25,080 minus 17,710 minus 3940. So this is 3430. Our tax was so from even the initial method we used
1350.
1350. So we got the 1350 by doing all of these analyses. Rest the 1350 there. So that is 2080. I think this is the same one you got when you were using the indirect method. Is that correct? That's true. Is that one true?
Yes.
So that is the one. So for if you were to do investing, it's just you could have copied what you did in indirect method. So investing activities and financing activities. And the financing activities are the same in both methods. In both indirect and the direct method. In both indirect and direct methods. And that one marks the end of the question of November 2016 using both direct and indirect methods. I would request that when you get time, try to check June 2013 question 4. This one you can use for your revision. December 2013, question 3. May 2015, question 1. May 2015, question 1. And there's another question here. November 2018, question 4. I would like to see how you do November. So I would request that you start with November 2018, question 4. So try and do this first. Then others will follow. The November 2018, question 4. So that if you can share to the normal WhatsApp group, so I see what you have done. Then when we meet next time, I would like to do earnings per share, International Accounting Standards 33, on how to compute for the diluted earnings per share and the basic earnings per share. Have a good night. If there's no question, continue with your revision well, and all the best.